At Lyrical, to our core, we're value investors. And what that means is that we only buy stocks from the cheapest part of the market. Now, most companies within the cheap part of the market are not good businesses. But we believe that if we work diligently, we can find good companies hiding out in this cheap part of the market. We call it finding the gems amid the junk. Now, why look for companies in this cheap part of the market? Well, the answer is quite simple. These stocks have delivered the most enduring source of alpha in markets over time. And that's what you see here. This light blue line going back to the 70s shows you our hunting ground, the cheapest quintile, the cheapest 20% of businesses in the world. Over time, they've outperformed the MSCI World and the MSCI World Value by more than 5 percentage points per year. And now this is in spite of the fundamentals. As I said, on average, value companies are not good companies. Over this period of time going back to the 70s, these cheapest 20% of stocks have undergrown the market on an earnings basis by about 3% per year. So why does it work? Well, value works in spite of the fundamentals. Nobody wants to own a bad business, and so therefore it becomes too cheap, and then it re-rates. Now, the Lyrical approach is different than that. We believe that hiding out in that light blue line are some good businesses that can grow their earnings actually at a market rate or faster. And if we can find them, we can deliver fantastic returns by combining value factor returns, just buying the cheap stocks, with the power of compound earnings. Now, how do we locate these businesses? It's through our investment discipline: value, quality, and analyzability. Every company that we own must have these 3 characteristics. Well, value we've discussed. It's the fuel for our returns. Buy stocks in the cheapest part of the market and you should get the value factor. But we want to do better than that. So first of all, we look for quality companies. To be fair, we're never going to own the best businesses in the world. I'll leave that to some of my peers who will speak next. But we can own good enough companies that have double-digit plus returns on capital. On average, our portfolio is close to the 20% mark. Having those types of returns means that you have a competitive advantage. It means you have a moat, and that makes your business a lot more resilient, and it means you can reinvest at those rates of returns and grow above the market, which we've done, as I'll show you in a moment. Now, the last thing we require, we call it analyzability. And for us, it means keep it simple. There are no style points in investing. You shouldn't care if we go after the complex, difficult situations or the easy-to-predict companies. And so we go after businesses that are predictable, where we can reliably get the earnings right. So this approach, looking for value and looking for quality, it produces a truly uncommon combination of value and growth. And this slide here, it's the most important one to showcase what Lyrical does. These are our portfolio fundamentals. So again, value, it means different things to different people, but to us, it means ridiculously cheap. You can look at our portfolio. We trade for about 10.5 times earnings today. So indeed, we are in that cheap part of the market, but that is not sufficient. Again, we want to do better than that. And we've done that, you can see on the right side, by putting together a portfolio that has delivered compound earnings growth above the MSCI World and above the world value. You can see there, value companies undergrow, but not our companies. Now, good, cheap, and simple. The market is not supposed to give you these 3 things together. And so I often find it's helpful to walk through a couple of examples, which we'll do now. So here we have Ameriprise, and we've owned this stock actually since 2012. And I'm showing you 3 views of Ameriprise. At the top, we have the stock price going back to 2011. In the middle, we have the earnings per share. And at the bottom, we have the PE multiple, or the valuation. So if you take the top chart divided by the middle, you've got the valuation at the bottom. So this company has grown earnings at a 15% rate and trades for 12 times earnings. What is this growthy company? Well, it's a business that you might not know of, but you'd be familiar with what it is. It's a financial advisor. So they have 10,000 financial advisors in the US managing the wealth of 2 million people. So how does it stack up on the lyrical criteria? Value, quality, analyzability. Well, from a value perspective, 15% earnings growth at 12 times PE, that looks pretty good. And it looks better when we compare it to the MSCI World. That's triple the earnings growth at a near 40% discount. What about quality? Well, as you would know, once you win a client as a financial advisor, those clients tend to stick with you for life. It's a very sticky business, and there's limited capital required for this business, which leads to returns on capital actually north of 40%. Analyzability. Can we predict it? Well, take a look at that earnings line. This is a business that, even though it grows with markets, has had very limited cyclicality, growing earnings even in 2022 when the MSCI World was down by 13%. Now let's look at another one. Speaking of resilient businesses, this is Cigna. Again, a very simple business. It's a healthcare insurer in the US. What they do is they combine the healthcare spending of 20 million individuals, and by doing so, they can negotiate lower healthcare costs on their behalf. How does it look on value? Well, 14% earnings growth. Again, nearly triple the MSCI Worlds. And at the bottom, as you can see, the multiple only 12 times earnings. Again, a near 40% discount to the market. Now, we put together a portfolio of good, cheap, simple businesses, but why should you care? Especially, why should you care when the only thing that seems to work these days are big tech and AI? Well, if you're asking yourself that question, the answer is that that's usually a good time to be buying value stocks. And we see that very clearly here. What this shows you is the market's earnings, PE multiple, so the valuation of the median stock in the world, at about 17 times today, and the valuation of the median cheapest stock at about 8.4 times. And the bottom shows you the spread between the two. It's an incredibly extreme time in the value space today where the market is 100% more expensive, 105% more expensive than the cheapest part of the market. Now, if you go back to the global financial crisis, that spread peaked out at 80%. That was a fantastic time to buy value stocks. Actually, if you want to find a similar spread to this, you have to go back further than we're showing on this chart, which is go to the end of 99 when there's a similar valuation spread. And we all know what happened after that. In 2000, the NASDAQ was down nearly 40%. Cheap stocks went up about 30%, and the MSCI World was down. So why is Lyrical the right firm to get your value exposure? Well, we do this one thing and one thing only. We've been doing it since 2008. We're a boutique based in New York City. And our investment team, our senior investment team, we've all had this same evolution to our philosophy. We all came from the same family of deep value funds, but we all had that personal epiphany where we realized that there were some pretty good companies hiding out in that cheap part of the market. And if we could only hold them for the long term, we could make a lot more money and make our investors more happy. Now at Lyrical, we're different. We're different than the benchmark. We're different than our peers. We have a 99% active share. And what that means is that if you look at us relative to the MSCI World, even though we're buying stocks from the MSCI World, we only have a 1% overlap with that benchmark. And relative to any other global peer, we have very low overlap. It is a unique combination, an uncommon combination of value and growth, and we believe it can provide outstanding returns over the long haul. Thank you.